Well, good afternoon, everybody, and welcome to today's seminar. My name is Adrian Panow. I'm Director of Major Projects within the Melbourne Energy Institute, and I'll be moderating today's discussion. Before we begin, I would like to acknowledge that we're gathered on the lands of the Wurundjeri, Woiwurrung, and the Boonwurrung people, who've been the custodian of this land for many generations and thousands of years, and acknowledge and pay our respects to their elders past, present and emerging. And for those who are online today, I also encourage you to acknowledge the lands on which you find yourselves, and in the context of this seminar in particular, many of those lands are in fact offshore and coastal as well. Thank you for joining us today for the first of a series in 2023 of seminars in which we'll focus on the energy commodities. Last year we're more around the technologies. This year we're looking at the commodities. And there is a broad range there that, this is not changing slides. Right, so this seminar is on crude oil and product supply chains, and then we'll also cover, perhaps unconventionally, but we'll cover uranium mining, other energy commodities, new and emerging commodities, as well as critical minerals, and then wrapping it up at the end of the year, towards the end of the year on fiscal policy, and all of which, of course, none of this happens without a market in place. The speakers, and just before I get into the speakers, it's now working. For those of us who are online, or for those online, and that's the vast majority of today's meeting, if you can enter your questions into the Q&A chat box, into the Q&A box rather than chat, which has been disabled, and we'll get through to them at the end. So the speaker today, Nicholas James, is Technical Manager at Viva Energy Australia, and he manages very large engineering commercial teams of 40 plus direct engineers and 60 contracting engineers. And he's been part of Viva for almost a decade, managing economics, scheduling production and the refinery. And he's led the refinery through both COVID and international conflict as well. Worked as, and my notes say here, a crude economist. I'm sure it's a cultured crude economist, and in Singapore oil trading, supply logistics, and has a very good understanding of hydrocarbon flow. And prior to that, he worked in economics and scheduling at Shell in Geelong, process engineer at New Farm and Qenos, and is a University of Melbourne graduate in chemical engineering and science. So I will stop there and move over to Nick. Thank you.
Hi everyone. I'm now the supply and technical manager. So I got my old commercial team back, is what happened about a month ago. So there's a brief sort of rundown of my history, but basically probably a chemical engineer, normal grad sort of stuff for about 3 to 5 years. Got to work on a cogen plant at Qenos, which was really exciting. I enjoyed that. But then I realized I wasn't a very good engineer, so I went over to commercial, and I went to the economics and scheduling team in the refinery. And that's kind of the thing that I really enjoyed and loved doing. I've been on site there for 10 years, and part of that economics and scheduling team, I went and did all the different roles there. The start of it is just run planning. So how do we put this through the refinery? How do we make gasoline? How do we make gas oil? How do we make jet fuel? The real basic sort of stuff. I did that for a couple of years. And then I became the refinery economist. That was a very interesting job. Probably half of that is trying to figure out how to make money out of a refinery. During that time, we transitioned from Shell to Viva. That transition was very interesting for me, and probably very formative for me, going from the big behemoth, I guess, of Shell and all the bureaucracy that sort of came with that, to working into sort of private ownership. That was driven by Vitol, who are a very large independent crude trader. They taught me a lot about commercial markets and the world and break evens and are you making money? So they really sharpened me up. Before, you would always have the vice president of this division in Shell would tell you what to do. In Vitol, they talked to me directly and said, how are you making money off that cargo? Do you understand all of it end to end? And that really sharpened up our refinery and kept us running. So they were quite a big punt to invest in refining. That was in what, 2013, 14, that transition. Because we've always been sort of at the point of whether we would survive or not. We had a few good years from 2015, 16, 17. The markets were strong and the refinery made money. Then we had some, so through that time I was an economist, bit of growth, we got some projects. I learned a lot. Then I went into the crude buying space. So I worked with the crude traders for a couple of years. My friends in Singapore and Vitol, again, I learned a little bit more about that world and how important freight is, how deals are done and actual oil trading. So I did that for a few years. And then I was the economics and scheduling manager for about 4 years at the refinery. During that time, it was sort of day-to-day operations. How do we make money? And then 2020 happened. And then we went into the chaos of COVID, which completely flipped everything. Obviously for everyone, in particular for oil markets, all of the norms and what you thought was normal completely didn't exist, is what happened. So we went through that. We went through critical, are we critical infrastructure with the government? So we started working with the government quite a lot. We were doing break-evens about whether we should run the refinery. So obviously 3 refineries shut during COVID in our area. So we had BP, Kwinana, the Altona refinery and the New Zealand refinery as well shut during that time. So they made the decision to not progress. We, working closely with the government and fuel under the sort of view about critical infrastructure, kept our refinery open. And a lot of that was based on fuel security and the rest of it. And I was always a bit on the fence about fuel security. I was like, you can always import it. There's big refiners in Singapore and the rest of it. Does fuel security really mean that much? And I was taught a lesson in February 2021 when the Russian-Ukraine action happened. And then we saw a huge change in the markets again. So the exact opposite way, where there was a real refining short that happened, a real product short that happened, particularly with diesel. And so we were really struggling to buy cargoes. We were trying to buy off-spec cargoes. If we didn't have our refinery running, there would have been shortages. I reckon that we were being very close. It was tough to do during that time. So we went from a refinery, these results are public. I think we lost about $200 million EBITDA in 2020, and we've made close to $500 million in 2021. So it is a world of swings around the pounds refining. And that's all with a big capital base where we're spending, somewhere between $100 to $200 million a year on just capital projects to keep the refinery running. So that was all that sort of space. After surviving COVID, I went across to engineering teams. So I went to the technical manager. So I was sort of managing all the engineers, about, like I was saying, about 40 odd process engineers, about 20 integrity engineers and all the rest of it. So I did a little bit less commercial for about a year. That was really interesting to manage teams and do a little bit more of the technology part, because I did want to be part of the transition. And I saw a big gap. I think someone mentioned before that the talking from engineers to commercial was what was the gap that I wanted to bridge. So the engineers have got ideas about how to do things or not do things. And the commercial people are like, where's the result? Where's the sale? And all the rest of it. So I wanted to use my background to bridge that. And then in the last sort of month, I've got my old commercial team back. So now I would be called the supply and trade and technical manager. So I've got that crude trading piece, sort of my old background back again. And now it's trying to gel that forward to what does the refinery plan look like between here and 2030, which is our next sort of major investment decision. And what do we do with energy transition as well? So how do we solve that problem with the infrastructure that we have? I could probably talk about that forever, but you did want to talk about base business somewhat, I think was some of the brief here. So Oh, sorry, I'm a wanderer. And I usually like asking questions of the team and all the rest of it too. I get very bored of my presentations. Oh, sorry. So they've just been staring at there. All right. Hello, everyone. So I'll just go through some of the basics of what's going on here. Here's a map of the world that hasn't shown up, so that's good. But basically, where does all the oil come from and all the rest of it? So you've got obviously the massive amount of oil is obviously controlled by OPEC. It's controlling about 70% of all the oil. Their term deals, they tell you what the price is. You're not allowed to trade their oil openly and all the rest of it. So, you know, the Saudis will set a price for all of their crudes. That's the, you know, for the Arab Light, and they'll put it out each month, and then everyone will trade off and around it. So they control huge amounts of the world. And then you've got obviously the big buyers in China and Europe. Probably what's interesting in my time is that the United States used to be a big net importer of gas oil, particularly from the Saudis. And Venezuela is where they used to pull in their heavy sour products. And then we had quite the explosion has happened out there with the Permian Basin and Midland coming out. So that's millions and millions of barrels of crude is now coming out, which is a sort of light sweet crude, which has sort of changed that dynamic quite a lot. They do export a lot of that, and we run it at our refinery quite a lot, but that's a big shift that has happened in the market. Then on top of that, so you've got the United States, and then you've got OPEC, you know, Russia obviously being a major exporter and running pretty much all of Europe running on the Russian barrels. In our region, particularly, the Far East are sort of coming back quite a lot. So there's not a lot of oil in the Far East. Traditionally, we would have bought that out of Petronas and out of Malaysia. That crude is drying up. There's less investment in there, so there's not that many wells happening there. So that light sweet material coming out of the Far East is coming back, and I would say similar for Australia as well. So it's all over the place how the world works and how it trades, and whether these arbs open between United States and Europe or United States to the Far East. All of those arbitrages depend on what's short, what's long, and what's the freight economics on how all these things flow. But yes, I've got some pictures here. So this is probably a better look at what has happened. So this is pretty outdated, what I would say. So that red one, I think, has gone green. So you've got a net exporter of oil from the United States. This is very red. So our region is quite short. Obviously, you got quite long out of the Middle East, you know, with Dubai and the Arabs. And then you've got here in Europe, very short. And China also pulling in large amounts of barrels. And they'll pull that in from sort of a number of different regions. And you can obviously see here, the dislocation that happened when Russia sort of shut off was huge. So, and I don't know how much detail you guys know, but all these lines here are depending on what arbitrages are open and closed. So that's where's the supply balance look like in the market and what are the freight economics. So, and I'll probably talk to a little bit more detail about that then, about when do these flows open that they would make money. And those are traded sort of monthly, depending on, or yeah, mostly monthly, about where those contracts are going to go and move. So you get this balance gets upset by OPEC doing something, you know, which is basically OPEC plus, which is these two, or whether you have, you know, unrest, which would be out here. So in Libya and all the rest of it has had a number of unrest, which cuts off barrels quite quickly. Venezuela, similar. Iran, similar, which are all millions of barrels that come on and off and have huge effects to the market. So that's a nice big web is what I want to show you, because it's constantly, everyone's looking for an angle for where you can make money out of those different oil flows. And it's, yeah, very openly traded all throughout the world. A little bit about crude qualities. So generally the big refiners, so these are refineries that are about 500,000 to 1 million barrels a day. Our refinery in Geelong is 120,000 barrels a day. So 10 times the size of what we have here in Australia. And Lytton, our other refinery in Australia, is the same as ours, about 100,000 barrels. So we make about 200,000 barrels. So we're a little dot compared to the refiners in the Middle East and India, where they are, they've got mega refineries. Korea is also a huge refiner as well. Generally, so you've got S-Oil, which is the Koreans, and some of the Indians here in our world run on these crudes, the big, heavy, sour crudes. They're traditional crudes. They're out of Dubai and Saudi Arabia. So they're the ones that their whole refinery, usually they're actually in joint ventures with the Saudis and Dubai and ADNOC and all the other crude players. So they will be sort of joint ventures with there. And then we've got the other refiners up here in the light sweet area, which is far less crude. They're generally less termed up and less just running one set of oil. Us ourselves, we run about 50 to 60 different oils a year. So we're changing constantly our crudes, just trying to get the right mix and also trying to find the right value. So we're trading these very little cargoes around this world, while these guys are the big refiners sort of trying to straight line their refinery where possible on the different crudes. So obviously you're getting very different products out of here, out of your refinery. And you're also getting, it depends what kind of also, how complex your refinery is. So I don't know if you guys know much about refining, but the complexity is basically how much you can turn that crude into products. So a simple distillation column would be the simple refinery. You put it through a distillation column, you're going to make products like naphtha, which needs to go cracked and turned into chemicals later. You can make jet fuel and gas oil, which is pretty much just comes straight out of the middle of a distillation column. And then you'll make a residue that you also sell. So that's the simple refinery. Then you have levels of upgrading, which is the hydroskimming refinery, which will upgrade the naphtha. And then you've also got a kind of a fully complex refinery where you'll have either a coker, a hydrocracker, or a fluidized cat cracker, which will upgrade the bottom into all kinds of gasoline, diesel, all your white products, which is what we would call anything jet, kerosene, diesel, gasoline is what we call a white product. So depending on what kind of setup you got refinery, depends on what oil you can sort of run and what your yield set and how much money you will make out of your refinery. Feel free to ask any questions while you're going on. So I will ramble quite a bit. So steer me onto a track if there's something that interests you. A little bit about Australia and their crude, how much crude that we've got. I would say not much. So we've obviously got crude here. So that's Gippsland crude is what and so that's what the Altona refinery and our Corio refinery is built on. So we were built to run on the Gippsland crude. That is drying up. They should turn off production next year. So they're just about done. So now they're only making gas. So we get gas condensate pretty much coming down there. So before I could run my whole refinery on it, I would make residue, I would make gas oil, I would make the whole suite. And then I would top that up with a bit of heavy stuff from the Middle East. Now that will make up about 5 to 10% of my diet in the refinery, and it only fills the very top fraction. So it's a very different crude now. So that is going to shut down. And then there's general issues about when does that whole operation close down. So I don't want to talk about our competitors, but there's an impending timeline for that Gippsland Basin. I guess that's also a piece of what Viva's exploring and trying to do at the moment is how are we going to make up for that gas shortfall? Because all of Victoria is built on gas infrastructure. So most of us have gas to our houses and all the rest of it. So how do we transition away from that? And the domestic gas use and this general industrial gas use that Victoria has, how do we transition away from that once supply becomes very constrained? Getting it down from Queensland to here is very difficult. So that the gas is there if it isn't all sold to the Japanese, but it is very difficult to get the pipeline time to do it. So, and we've seen that with gas shortages, and it's going to be interesting to see what happens this winter. Anyway, I did a bit of gas trading once upon a time. So that's interesting what goes on there. we've got here is the massive Cooper Basin. So that's like the size of like countries, obviously, it's huge. So that's pulling out about 600 kb of crude about every month. So that Cooper crude is something that we've run at our refinery for the last probably 5 years, so quite a lot of it. So that all comes through the Moomba Basin here. So the gas is coming into Sydney and a little bit into Brisbane. And then the rest of it is actually pumped all the way down to Port Bonython here and shipped across to us. So that's a crude that we know very well. And then you've got all this light crude that comes out of, gas condensates and the rest of it coming out of the Northwest Shelf. So you've got huge projects, old projects there, the Northwest Shelf. You've got Prelude, which everyone went to when the refineries announced the sale. They took all our good engineers and they went to Prelude. I'm proud to say that I've made a lot more products than they have in their 10 years that they've disappeared. So they've had a lot of issues commissioning that project on a $10 million floating boat. But then we've also got crudes up there, like Ichthys is a new crude that's come on up there in Darwin from Inpex. So that's a big joint venture with the Japanese, producing a lot of gas out of the, was it the Timor Sea there, up the top. So generally, and this is all world scale, this is all quite small. Condensates were a player, gas were a player, crude oil, absolutely not. So yeah, the Saudis are making millions of barrels per day, and we make 600,000 barrels a month. So it's kind of that kind of magnitude that happens there. Right, supply chain. So kind of how does it work? So it's a little bit, if we go from all the way from start to finish. So I'm not sure how much detail I want to talk to here, but I'll keep going. So we got basically what happens is you'll have the tenders go out for the crude. So the crude suppliers, so I'll give you the example of Petronas. So that's like a state-owned, well, mostly state-owned Malaysian oil company. So they'll put out their, also the Malaysian crude oils, we would call them, the MCOs, they'll put out their tender on about the 20th of every month saying, this is the lot of crudes that are coming out, and this is the price that I want to sell them at. The crude traders will then go and pick and poke. Someone will buy that crude and then they'll on-trade it and all the rest of it. So this is your Vitol, your Trafigura, your Shell, BP, Exxon. They're all playing in that world, trading all of these crudes about 60 days out is the normal contract, tender contract for these, for all the different crudes that come out. So they're going to put out, say, 8 cargoes. So they're going to say there's going to be 8 cargoes this month. Those cargoes are about 600,000 barrels. And you guys go trade them and see what value you can get out of them. And they're going to put that out. If I talk pricing, everything, the crude that we are buying mostly is pricing off data Brent, which is the sweet marker, right? So that's the sweet crude marker, which is set by usually Platts, set that up. And that's what the sweet crude that is traded, Brent's a tiny crude traded off the Northwest Shelf of, the North Sea in England. And that sets the price that everyone trades off for trading sweet crude is off data Brent. So they'll go, it's Brent plus $5 to $8 or something like that. So that's the premier above that sweet benchmark that we will trade off. So we will do the deal saying that we're going to buy a Kemanis crude for Brent plus $5. So that's the deal that I would have done in my previous life. And I've had a full simulation of my refinery telling me, is that how much money am I going to make out of that crude? So I'll go, I can make another $8 a barrel out of that crude if I buy it. And so my break even is here. This is where I want to do it. So this is this sort of iterations that we do with our simulations of our refinery. So I bought that crude. Then I'll go to talk to my trading teams about how do I ship it to the refinery. I'll talk shipping a little bit later. So I'm going to go I'm going to go hire a boat or set a contract with a boat to move the oil down to Australia. So I've got, I'm tendering, so the freight traders are all working with the shipping owners there to determine a boat that's going to go and do that contract for me. And that's traded off of world scale points. So that's the way that they trade freight, is that it'll be a world scale flat times world scale points equals a total shipping cost. you know, about them at the moment, it's about $2 million for a voyage from Singapore to our refinery, which translates to like, you know, about $3 to $4 a barrel is the cost. So that, how we trade the points is how all of that sort of trades in that point. I bring it into my refinery, I make all the different fuels out of it, and then the same thing happens. I either send it up a pipeline to Yarraville, which is where I live, and then all to the terminals there, goes in a truck, which is probably here, and then we'll get to your retail sites. All of those are just added costs all the way through. So we predominantly run on pipelines. We've got 2 pipelines that run from Geelong to Newport, which pump about 80% of the refinery's production up there and produce and hold about 60% of all Victoria's fuel goes up those 2 pipelines. And then we ship our, if it's economic, we'll ship some of our production out to the different terminals. Am I going for time? Talking too much? Probably. So I've gone a bit ahead of time, but this is a little bit about how that build up kind of works. So for the crude oil, or if we're talking here for a product, basically it's the traded, so all the products sort of trade off their own markers. Like I said, sweet crude will trade off dated Brent, sour crude will typically trade off Dubai. So that's you know, out of Abu Dhabi there. So that it'll be Dubai plus or minus a certain premium depending on what kind of crude we've got. And then we've also got West Texas, which is the other major sort of trade for a light sweet crude out of America. And everything sort of trades on, usually trades on a number out of there. Then we will go pay, and for the products, we have obviously markers for diesel, so D10, so 10 ppm diesel. There is higher sulfur diesels as well. 10 ppm diesel, we have jet, and gasoline, 92, 95, 97 are the main markers that's traded off, all for the different qualities. So you get that marker plus or minus a premium, depending on how you've gone trading. So you've bought that, and then you pay for your freight, like I said, which is a good $2 to $3 a barrel, and then you land it into Melbourne. So how much more you pay for your diesel is how good are your logistics from there. So logistics are extremely important for making deals work, and what are the boat owners doing and all the rest of it. Because the margins that you're working at, if you're a terminal person, you may be working on $2 to $3 a barrel margin. So you might make $1 million each cargo, something like that. A refiner, we're generally, I have a gross margin, we're trying to get to about $8 to $10 a barrel. And that's because the running cost of the refinery, including capital, is probably close to $6 to $8 a barrel. So it costs many, many millions of dollars to run a refinery. So if you've got a margin of $2 to $3 a barrel, you can lose it all on boats very quickly. And if you don't get your supply chain right and you've got a boat sitting out there in the bay, they can cost between $30,000 to $100,000 a day if you get it wrong. So having the boat sitting out there at Holden Dock or outside of our refinery is very expensive. So people have whole careers on freight. It is kind of crucial for how oil works. All right, so this is a bit more about freight, spot voyage, and there's different ways that you can pay for your freight too. So we generally do spot voyage, so spot voyages, which is I've hired the boat for X amount of time to do a certain voyage, and that's traded. You could lock that in, so that would be called a time charter, or TC is what we would normally be calling it. So I've got that boat for a year and it has to do what I say. You can do that. You'll pay a premium for it, but you're less exposed to the market going up and down. So a TC, and also it's nice for refiners because I get to go, when I change my mind, I don't have to recharter and cost another $1 million, which will get me in trouble. Or if you're a big owner, you'll have certain boats. So Vitol have a whole fleet of boats that we will also charter from as well. So that's a little bit about how it works, but how making all the logistics fits together will make or break whether you're profitable or not. And how good is your infrastructure to get boats in and out, and how deep you can load a boat is also very important. So if you can put more on a boat for the same cost, you will make money. It is that simple. And I'll complain about the draft. So the draft at our refinery is quite shallow. So I can only get about 11 meters in my boat in through Corio there. So what that means is I've got 11-meter draft. I can put about 600,000 barrels on my Aframax boat. Still cost me exactly the same. Whilst if I was at Lytton or in Sydney, I could load that to about 14 meters draft, so an extra 3 meters, and I can put about another 150 barrels on that. So that means that I'm paying about another $100,000 to $200,000 per ship for everything because we've got a bad draft. I mean, it's obviously very difficult and environmentally problematic to dredge the bay to solve that problem, but that's an inherent issue with our refinery. So we're a poor draft refinery, but that eats into 20–30% of our margin every time we run it. And we pass that on to you guys as well, right? So that's that you pay for that at the pump. So that sets some of our transfer pricing at the refinery too, our poor logistics. So that's sort of how that works. Like I said, I'm not really a boat guy. You have to respect it. I'm a refiner. But yeah, there's all kinds of different boats and people will talk forever about it. We've got whole people that do it. Just know that the boats are massive. Yeah. And, you know, when we had COVID, we just had boats like this floating everywhere. So during COVID, freight went through the roof is because no one could sell their products. And also all the ports were closing because everyone didn't want to get COVID. And, you know, you've got international travelers. We had a number of crew boats where people had COVID on them, you know, you have Ruby Princess sort of stuff going on, not to that extent, but we did have that very real issue. And so then we had all of our boats were sort of tied up with floating stock. That means that freight went through the roof. So it was very expensive to freight everywhere, but no one wanted the product. So that meant that all of the margins were suppressed. That means that we make no money and we've got to have crisis talks with the government. So that's sort of what happened to us and the world. So it is, as much as crude oil is traded up and down and all the rest of it, freight is very much as well. And these boats are, yeah, like I said, are huge. The boats that we get in are about 250 meters long and about 50 meters wide, and all the rest of it. So a little bit about terms. So this is how our deals sort of set up and work. So how do we do our deals? And to me, it's a little bit about who's paying the freight and where does the risk set. The risk is also very important. There's no guarantees when you buy crude. So when you buy crude, is all relationship. So if I buy crude and I run it and I go, that didn't have any diesel in it, that was all condensate, all I can do is complain. There is no, oh, you didn't meet the specification, all the rest of it. So it's all done on relationship. So when you see, there's always a fairly large element of risk. You can do a bit of low port testing on the rest of it, but there's always this interaction that happens. So where that title deed comes across is very important. So, and even more for clean products, you can obviously complain and you can send a ship back to Singapore and have all kinds of problems with if we have contaminants with our clean fuels. And that depends on where does our risk transfer. So typically we will buy FOB, so free on board. So that means that the seller has made the product, got it all onto the port. And so once they've loaded it onto the vessel, they're going, I've got the certs, everything's done, nothing to do with me anymore. And so from here, I've got all of the liability of the freight costs. So if that ship went and put its inert gas system and purged it into my tanks and put all soot into my diesel tanks and stocked out Newcastle, which happened to me last year, that's our issue, right, to deal with. So I've got to deal with that ship owner about that problem, not the product seller. So I'll do all the deals and then I'll add the freight to it. Sometimes other producers will want to do it CFR or CIF, and that's because their oil field may be, particularly for something like Ichthys, they've got a limited window to load that condensate. They don't load that condensate, they don't have the tankage, they'll stop production. So they're like, I don't want the risk of you not getting a ship in time and not putting it in the right spot. I will only give it to you delivered. So you will take it when I say, and you will pay that freight for it. So that's a little bit of how they will take on more of the risk, but they get to dictate where the shipping sits. But if you can see here the risk, so they will pay for the shipping, but if the boat owner contaminates your cargo, it's still your problem. So that's generally how the deals are done. It's only the specialty products that really have the risk all the way down to the end user. So that's basically how that works. You need to know this when you're trading. There's lots of money and lots of risk and disputes that happen. So you need to be sharp on this and where it all sits. A bit about hedging. We do a bit of hedging. Well, we have to hedge flat price. So if you want to be open on your flat price position, so that the flat price position is kind of like the total oil cost, right? So if I'm talking flat price, I'm generally talking about the Brent price, the flat price of crude. At the moment, sort of like, what is it today? $80 odd a barrel for that number. And then I'm refining that, turning it into products. And generally all the products have got a delta against that crude. Like I have a diesel crack of $10. We call these cracks, the margins. $10. I'll have gasoline's actually stronger, $15 a barrel and all the rest of it. But you don't want to be sitting there and then you have a world event, either OPEC say that they're going to go and crash the market, which is what they did during COVID. So we had COVID happen and then OPEC said, nah, we don't like you guys. We don't like the Americans. We're going to increase production when the world is in a lot of pain. And we had negative crude what was that? Probably April of 2020. Yeah. We had negative numbers coming out of America because they went to go pick a fight with the Americans and they nearly bankrupted the Saudis. Well, they got a lot of gold, but that caused a lot of pain. So if you're at that position and you're holding, because our inventories we're holding, geez, probably $500 to $1 billion worth of oil. So if you're in the wrong position and you just lost 60% of your position, I'm like Porter Davis. I got no money. I got no cash flow, right? So you're in a lot of trouble. If you got those exposures, that's the full flat price exposures. So we're always making sure that we've got enough product that we can sell against my Brent that I'm bringing in to make sure I don't have too much of a flat price exposure. And I might be buying Brent in the future to make sure that the money coming in, I know the price of. So I'm not caught between pricing months between M+1 +2 +3 and also exposed to those big events. I think it was Trafigura, which is obviously a major trading course. They had a few really bad exposures during that time. And you could also short the market and make huge amounts of millions as well the other way. But you need to be very careful of that. So we have our general oil price hedge, and then you have a refinery hedge, which we play a little bit in that space. So some refiners will hedge their entire production. So essentially what they've done is they've bought futures in Brent and they've bought futures in our products. So they bought 1 million barrels of Brent crude in M+2, so you can buy the paper money, the futures for that. And then you've essentially also bought the 600,000 barrels of jet, 400,000 barrels of diesel in that forward months as well. So you actually lock in your price. So people will buy for it. Generally, when you're doing that, there's obviously a risk premium with that. And generally you're going to lose. It's generally there's a cost to it. So you don't have the exposure of, again, another world event where you could have made a lot of money or you could have lost a lot of money. But if you've got big capital investment, some refiners will like to play in that space. They're like, I want to know my cash flow and I will hedge 80 to 90% of my production, which was a bit what Shell did and particularly do out of the Far East for their Buckham refinery and other ones. We, Vitol, always think that they know better, my trading overlords. They're very sharp and in the market and they like to manage it, but they want us to, we generally run a closer to a spot position. So we're exposed to the market going up and down. So that's a little bit about how that world works, about how much because everything can be traded on paper as opposed to physical oil. But you do need to have the physical oil production to trade. Otherwise, because you will be caught, you can get called on that and you have to deliver the oil. It's sort of how those positions are open and closed. Right. How am I going for time? 10 minutes. Oh dear. I'd explain a refinery in 5 minutes. All right. Right, so refining is generally just boiling oil. There's a pretty picture of how it sort of works. Distillation column. So obviously we've got huge amount of energy use at the refinery. So we've got furnaces everywhere at the refinery, many megawatts of furnaces. So we're burning sort of 500 to 600, probably 600 tons of gas a day. About 400 tons of that is our own produced gas, so refinery fuel gas. So that's C1s and C2s that come from our process. The rest of it's imported. So we're a major gas player, big suck on the economy. And that's, that's the scope 1 emissions for our refinery, which are close to about 1 million tons of CO2 equivalent a year is roughly what the refinery is exposed to on CO2. And that's because we use a lot of energy to boil oil and then cool it down. That's what we do. So that's fractionation, distillation. So we're pulling out all the different fractions out the top of our distillation column. Obviously, we've got a lot more fractionation there to make the cuts sharper. But generally at the top, you've got fuel gas. That's C1s and 2s. Then the next sort of fraction that you've got is LPG, C3s and C4s. So that's propane and butane. That's the stuff I'm putting in your barbecues and previously taxis when we used to run cars and LPG, not so much anymore, but there is quite a lot of commercial propane that we do sell as well. So we sell that direct to the market. We have a terminal that we sell that on. The next fraction after that is what we've got, the naphtha fraction, so your gasoline fractions. You've got light naphtha, which is generally what I would call bad gasoline component. So it's about 80 octane number and high volatility. So that's not great for blending my gasoline together. Then I make a heavy naphtha fraction, which is about 50 octane and pretty much useful for not much. So what we do with that is we get our naphtha, put it through our platinum reformer, which we're currently in turnaround opening up as we speak. That unit essentially turns all those naphthene molecules into aromatics. When you do that, you make benzene, toluene, and xylene. So your aromatics, BTEX. That stuff is why gasoline smells like it does and also looks like it does. It's about 110, 120 RON, octane, that is, research octane number, that material. So that's the good stuff that you blend everything else with. We do have units to get rid of the benzene as well, to saturate it. It's another chemical process that we do. And also when you do that and you form an aromatic ring, all the hydrogen splits off as well. So you make a lot of hydrogen. The hydrogen is very important because our diesel and kerosene fractions that come off there, we hydrotreat them. So we get them up to about 300 degrees, put them through our hydrotreater at about 60 bar. And that essentially liberates all the sulfur from those molecules, comes out as H2S gas. That H2S gas is then via amine transferred to our sulfur plant. I can never remember the reaction, Klaus reaction, turning that into liquid sulfur. That comes out as trucks and we send it up to Queensland. So we've got the middle fractions, which is the kerosene fraction, which is your jet fuel, your diesel fraction, your gas oil fraction, as we would call it, unhydrotreated fraction that you basically hydrotreat, get it to 10 ppm, put it in a truck. And then out the bottom, we have residue. So that residue fraction is the boiling point about 340 degrees. You can make bitumen out of it, depending on what crude you've got. And we do have a bitumen plant. So you can put it on a road. You can also put it into boats. So boats, engines are designed to run on the bottom of a distillation column. Heavy, dirty, ugly fuel. Or you can put it through an upgrading unit. We have a fluidized cat cracker. So we have a big cat cracker, which puts it in at about 500 degrees, which we're also starting up today. I hope they're doing okay. And that essentially cracks those big waxy paraffin molecules into a full suite of products that I was talking about there with gasoline, mostly gasoline diesel. And then you also get a bunch of LPG that comes off there. And part of the cat cracking process, we also lose a lot of hydrogen. So you make olefins, which is you make propylene. We also own a plant that makes plastic as well. So with the innovations that came out of Melbourne University, I am now the engineer for the plant. Well, very loosely the engineer for the plant that makes all the banknotes in the world too. So we make about 95% of the banknotes in the world come from our little polypropylene plant in Geelong. And that was because Australia made that technology. So it's a little selling point for us anyway. So basically we've got a fully complex refinery. So I don't sell any intermediates. Everything I put into a refinery, I sell as a product or burn it within our furnaces. So that's in a nutshell how refineries work. It's very complex. We have lots of different models. Like I said, I've got lots of engineers trying to figure out how all of this works. And my life has been trying to figure this out on a block flow place. How can I put it into how can I get a crude set, a diet of crude that fits through my distillation column? So not too much overheads, not too heavy. The qualities are okay so that I can make the products that I want to make. Obviously, I've got a lot of engineers that help me with that. I've got a linear program that helps me with that. And I've got a lot of operators on site that I talk to in general, which are always good fun to tell you how it used to be done back in the day, but they run everything at the plant. So we make all kinds of products come from oil, which is why the energy transition is going to be very challenging because the whole world is set up on the black stuff that comes out of the ground. So that's a little bit about the world that we live in. Obviously, Australia is, we've lost that refinery and that refinery. And so it's just us and Lytton trying to survive at the moment. And we're making, so now we make probably closer to about 20% of Australia's diesel. So Australia is now a decent short for products. So there's a lot of products coming in at the moment. Old refineries do make good terminals, but that's sort of how it all works. I'll keep going here because I'm running out of time. That's a little bit about Victoria's infrastructure. I was complaining about my berth here, pipelines up here. All the products are coming in here. So we've got the clean ships coming from Singapore generally coming up to here into the different pipes and then into the distribution systems everywhere. All of the jet comes down that sort of one pipeline from Somerton to Melbourne. That's starting to get very constrained again. It was very constrained in 2019. We then decided to sell no jet fuel for most of 2020, coming back probably 30% in 21, 60%, I'd say 22, now are about 80, 90% of demand for jet fuel. With obviously probably the biggest issue at the moment is people. And I would say, if I just keep on going quickly, pump pricing, so it's the government that makes you pay for it, not us. So that's a little bit about how that works. So it's all those constraints. I don't know if you wanted to hear about this, but generally the constraint that I see now is engineering is the constraint. So with energy transition, I took my new job into engineering to try and figure out how can we get a 70-year-old refinery to start transitioning. That's really the stuff that I wanted to be a part of. But with also a realization about the commercial aspects and how do you execute it. What we're finding now is actually having people who know about the real world and all the rest of it is kind of the challenge. Having people wanting to do chemical engineering and get involved in this work is quite a short at the moment. So I'm very much a recruitment drive trying to get people to come in so they don't want to work in a dirty industry like ours. But I'm like, if you don't work in our industry, you fundamentally won't understand supply chains and everything else I've been talking to you about. You won't understand safety, which is probably the biggest issue. So handling things at actual scale and safety. So that's another piece that our refinery teaches you very well. But then, also it's going to take a lot of capital. For us, we've got a decent balance sheet now. We've got a bunch of capital, so hopefully we can invest and change. But that's a lot of promises. Whether we do it or not is a big question. So that's a little bit of our work now is how do we expand upon different fuels. So if I think about it, I always think about it in terms of products. So for gasoline, there seems to be a decent answer for gasoline, which is EVs. They'll get better and better. So you go, okay, that looks like that's a transition fuel. That's probably the one leading the race here. As for gas, that's more problematic. So how do we transition from a gas economy and all the rest of it bit about biomethanes and things like that, but that seems hard, which is why I think Viva wants to invest in more gas, use gas to phase out coal. How do we phase out gas? There's not as clear a solution to that at the moment. And if you were to electrify it, which is also an answer, that's also extremely expensive as well. That infrastructure is immense. So how do you solve that? And you also, I think I went to a presentation, they needed a solar farm same the size as 2 Tasmanias, I think, to do that, to solve that problem. 6, is it? Yeah, so you guys know better than me. I'm like, that's just crazy. I'm like, we need to eat, we need farms and stuff like that too. So that's problematic as well. So is there a better solution to that? There will be. And then when you go into the heavier fuels, the diesel and the jet fuel, so looking into that, this is probably space I'm playing in a bit more at the moment, is, okay, we're investing in hydrogen. So a couple of the engineers that used to work on the reformer that I talked about that made the hydrogen, now building a hydrogen service station out the front of our refinery to figure out, can this work? Not sure about that either. Hydrogen's not a great fuel. Chemically, it's a beautiful fuel. Storage, handling, awful. The amount of loss that you get, the efficiency, I hate as a refiner. When you've got that much boil off and you got to hold that stuff at 200 odd bar, that's terrifying to me. So those sort of issues I can see is problematic for hydrogen, but as a fuel, it's quite nice. That will be some part of the answer. And then bios and tallows, use cooking oils, those sort of things are the answer. And they're the only real answer at the moment to airline fuel, SAF at the moment, particular. I can't see ever there being, well, not barely in my lifetime can I see planes moving to hydrogen or electric. I've just seen that, I've seen that sort of change nowhere in 20 years. I can't see it changing forward, but that's maybe probably being cynical about jet fuel because it's such high risk. While diesel, electric maybe a little bit. Bio is an easy answer at the moment. Can we make that bigger without impacting everyone else? You know, just taking soybean crops and turning into diesel is problematic, but a good answer in the short term. Before we generate ways of generating that oil, that carbon out of, you know, sort of waste streams and all the rest of it is interesting. And then marine, they're talking about either hydrogen or LNG as answers to that, and bio LNG. So there's all these little bits and all the rest of it. Anyone who tells you they know the answer, they don't. But it will be done by bits and pieces and all kinds of different technologies, the transition. And how we fit that into our refinery is very interesting to me. So I got to make less gasoline because I know that's gonna decline. So I got to turn that into different products. And how can I start substituting my oil feeds into something else to make diesels and SAF is kind of the challenge that we've got. And what I would say, it's probably far less government led than I ever thought. So, and the example that I would use is when we had the Russian-Ukraine intervention, war, whatever you want to call it, you saw everyone who boycotted there, that the governments did not do it first. It was all private. So they all had their ESG commitments. They did not want to be the people trading with Russia. And the majors stopped. And that's what stopped the oil flows. And then the government sort of caught up probably a month or so after. And so it was all of those guys who didn't want to be in the headlines, the ones trading with Putin, that stopped the oil flows. And at the moment, with the biggest pressure that we have as a refinery is not from the government saying that we need to change with the safeguarding mechanism, all the rest of it. That moves you in the right direction, definitely. But it's our shareholders that come to us and our board that say, you don't have a sustainable business. You need to actually change this. And so that's the expectation that has happened now. So it's not really a discussion about, oh, is it economic and should we do it anymore? It's how are you going to do it? Where are you playing? What are you doing? Because if we don't do that, then we're dinosaurs like the rest of them. So that's the market has completely moved on from, is it real, to how are you doing it? So it's been a pretty interesting journey over the last sort of 5 years in that space. All right, I've probably talked for ages and rambled. So yeah, that was my very brief introduction to oil flows, guys.
Right. Well, thank you very much, Nick. Fascinating journey on the way, and I think it highlights that be very careful what you wish for as we transition from one energy source to multiple other ones. And it also highlights that existing industries are usually where most of the talent is, most of the skills are for all of the new transition fuels, everything from how do you distribute hydrogen, if that's what we're talking about. And if you have an existing pipeline, well, you're not going to build a whole new one for a sustainable aviation fuel. For example, there's a pipeline that runs to Tullamarine Airport. Most people aren't aware of that. And it's
You'll never build it again.
You'll never do it again. You know, even things, we both live in Yarraville, and going past a 40-foot tanker that has a hazardous fuel in it, could you imagine going to the EPA these days and saying, oh, I'd just like to ship 40 foot of high explosive through a suburban street? And yet we do it because at the moment there really is no alternative. And so thank you. I think you've covered that whole range really well. We have one question online, and quite specifically around the freight and whether you'd seen a change in freight costs since the Russia-Ukraine conflict, and what sort of trend, and is it coming back?
It's immense. Oh, well, so that was a huge dislocation. So we had the huge dislocation happened in COVID, where basically all the boats were floating oil and people didn't know where to discharge. So then we had, you know, traditionally I was paying about $2 a barrel for freight. That went up to about $5 to $6 a barrel, so about 3 times. And so everyone wears it when that happens. Then that sort of went back down to about $4 a barrel, so about double what it was in 2019. Russia caused huge dislocation again. Because all the oil flows sort of got disconnected. So instead of doing, Russia has pipelines of Ural crude basically going into Germany and the rest of Europe, running it. All that stuff went down through the, now if I'm going to get my seas right, Black Sea, through there, and then started floating out there, you know, sort of around Turkey and all the rest of it. So all that crude got dislocated. People stopped getting the gas oil flows in pipelines, and then that started shipping around from America, the Far East, all the rest of it. So all those routes start going crazy all around the world. And that's where you see those big arbitrages, like I said, open up, where suddenly you're paying $8 to $10 a barrel. So you're paying 4 to 5 times what they were. At the moment, it's been pretty bad for the last 6 months, where you've been about, and we've had very high refining margins. They've been, you know, still 3 to 4 times what it was normal. As of the last 2 to 3 weeks, it's actually come off a lot. So now the world is thinking recession's coming, interest rates are high, cost of living is high, everyone's trying to slow us down, everyone's worried. And also the impact of Russia wasn't what it was. So there was the big gas oil sanction that we thought was going to happen out of Russia, and so they can't take gas oil. That flows are well and truly fixed now. India and China have solved most of the problem. So that equilibrium has sort of settled out. The risk has come down, and so refining margins have come down, gas oil margins have come down, and freight is coming down. So freight, I saw an email today, it was about half. So it's come down a lot. So that's probably still 50% higher than normal, but that's kind of the world we're living in now, where it looks to be normalizing. There is a big correction that's coming through. And yeah, that's general global monetary policy and also sentiment.
Good. Are there any questions on the floor? There are 2. We've got a couple of minutes. One over there.
Thanks, Nick. I'm really interested in your view on hydrogen carriers in the future, whether it's ammonia or methanol or whatever else, particularly as inputs to refineries in the future. And also interested in what your crystal ball says time frame might be for those sort of things to change.
I find that really hard to so Twiggy wants to build a terminal next to our refinery, right? So he wants to green ammonia, like at North Shore, which is literally like 200 meters from our refinery. Like I said, I've got a short of 200 to 300 ton a day of natural gas. I'm like, in theory, So getting that, distributing, so being like petrol, getting that, distributing it to all these little people and all the rest of it, I can't see that working, particularly not for hydrogen. That stuff is way too hard to do. For us, maybe. So we would have technology issues dealing with the hydrogen. I know that because I've got the problems already. So when I've got when I have a hydrotreater and I have a shutdown on that unit, so I crash shutdown on that unit, I go bang, I've got my whole fuel gas system fills with hydrogen. And then I have issues burning that material. So in general, I could take 50 to 100 tonne a day of hydrogen. So having some sort of heavy industry or some sort of base load, which is all the problem with renewable, base load, there could be something there. Without the base load, I find it's very hard to figure out how you would make this commercial. So if we did a longer term project, and if you partnered that with a electricity station, all the rest of it, maybe there's something there. But geez, it's a very inefficient and expensive way of doing it because you're going to lose half your energy. That's the problem. With compressing it, costs a lot of money. The boil off costs a lot of money. The ammonia to hydrogen costs a lot of money. Just when you're taking a ticket all the way through, that's kind of the problem with hydrogen. That'll improve with that technology. But I'm far from an expert, by the way. Yes.
We might stop that
please.
Discussion now, and given the time, I'll ask one more question and then come back to one on the floor. But yeah. I'll ask one that's online, and then we can close the webinar at least. So very much related, I think, to the last one of the timeline that you'd put on a complete substitution of crude products to alternatives.
I think, yeah, so EVs, I think, are really interesting. We think 2035, 2040 is where that transition is done of sorts. So, sort of 30% EVs by 2030, and then it'll scale up quickly from there. So I think that's timeline is probably, so that's when gasoline gets fully dislocated. As for sustainable airline fuel and all the rest of it, that solution's very hard. That'll be 2050. So I think 50% by 2035, 2040 would be the goal. But that's sort of hard. Diesel, probably similar as well. That's hard to solve. So I'd say 2040, 2050 would be sort of the magnitude. But if you wanted to build a SAF plant right now and all the rest of it, you're not online till 2030 plus. It is that hard to do the engineering, the supply chain, all the rest of it. The Chinese are better at it than most. But still the lead time is 5 to 8 years to get that plant up. Then you've got to make the money off it. So all
right. I'll cut you off at that point and thank our online participants. We had a very good turn up there, but we'll come back to the question on the floor. So I encourage everyone online to keep track of the MEI website. All of the events are posted on there. And, it's a very interesting grouping to look at how our energy is transported and supplied. And so thank you very much, Nick, for the seminar. So I'll end that.